There is a final promise that money makes to those who truly understand its nature. It's a promise that goes far beyond luxury, beyond status, beyond the simple accumulation of things. It's a promise of quiet power. The power of the predator who can afford to wait. The power of the fortress that can withstand any siege. The power of the grandmaster who sees the entire board while everyone else is fixated on their next frantic move. For decades, the world's greatest investor, Warren Buffett, has been living by this promise, a promise encoded not in his sprawling stock portfolio, but in the one asset most investors are taught to despise: cash. We are told that cash is trash, that it's a lazy, unproductive asset, a melting ice cube in the hot sun of inflation. We are told that to build wealth, you must be fully invested all the time, making your money work for you every second of every day. This idea is so pervasive, so deeply ingrained in the financial consciousness, that it feels like an immutable law of nature. But it is a lie. It is the very lie that keeps the 99% trapped in a cycle of buying high and selling low, of participating in the euphoria and then being crushed by the panic. Warren Buffett doesn't see cash as a melting ice cube, he sees it as a coiled spring. He doesn't see it as a lazy asset. He sees it as a weapon, patiently waiting in its armory, polished and ready. He views cash not as a drag on his returns, but as a strategic, perpetual, zero-cost call option on future opportunities. An option with no expiration date. An option on assets that will one day be offered up by sellers who are terrified, desperate, and forced to part with their treasures for pennies on the dollar. This is not just a clever turn of phrase. It is the central pillar of a philosophy that has built one of the greatest fortunes in human history. It is the costly market mistake it prevents, the compulsive, deeply human need to be 100% invested at all times, a need that guarantees you will have no firepower, no ammunition, when the once-in-a-generation bargains inevitably appear. Over the course of our journey today, you will undergo a financial transformation. You will learn the strategic value of patience and liquidity. You will stop seeing the cash in your account as a failure of imagination and start seeing it as the ultimate source of your financial power. You will gain the ability to act with breathtaking decisiveness and aggression when others are paralyzed by fear and forced to sell. This is the final promise. Not the promise of what your money can buy, but the promise of what your money can do when it is combined with the one virtue that the market can never, ever arbitrage away: patience. Let us begin with the first pillar, the psychological bedrock upon which this entire fortress is built. Understanding cash not just as a financial tool, but as a powerful antidote to the most destructive force in investing: the relentless, primal urge to simply do something. This is the mastery of patience in a world that screams for action. To understand this, we must travel back in time, not to a moment of brilliant action, but to a long, frustrating period of inaction. The years leading up to the great financial crisis of 2008. From 2004 to 2007, the stock market was a party. The housing market was roaring, credit was cheap, and financial innovation seemed to have conquered risk itself. The S&P 500 was on a tear, climbing relentlessly upward. And what was Warren Buffett doing? He was sitting on his hands. Berkshire Hathaway, his legendary investment vehicle, was accumulating cash, a lot of it. By the end of 2005, Berkshire was holding over $43 billion in cash and equivalents. By the end of 2006, it was nearly $46 billion. By the end of 2007, as the party on Wall Street reached its dizzying crescendo, Buffett was sitting on a mountain of nearly $45 billion. The criticism was relentless. Pundits on financial television questioned if the old man had lost his touch. Market commentators wrote articles about the cash drag on Berkshire's performance. Why was he paying his highly compensated investment managers, Todd Combs and Ted Weschler, to simply manage a pile of T-bills? In a bull market, holding cash means you are mathematically guaranteed to underperform. Your 10% cash holding earns next to nothing while the other 90% of the market is screaming upwards. It was a period of immense psychological pressure. Every day, the markets seemed to be proving him wrong. Every day, his peers were posting incredible returns, leveraging up, buying complex derivatives, and looking like geniuses. The pressure to join the party, to deploy that capital, to make it work, must have been astronomical. Imagine being the most famous investor in the world, and for 3 straight years, you are deliberately choosing to underperform, to look foolish in the short term. This wasn't just a financial decision, it was an act of profound psychological discipline. He was famous for saying that the stock market is a no-called strike game of baseball. You can stand at the plate and watch thousands of pitches go by, overvalued IPOs, complex financial instruments, hot growth stocks, and it costs you nothing. You can wait and wait and wait for that one perfect fat pitch right in your sweet spot. In the years before 2008, Buffett was watching pitch after pitch go by, and the crowd was booing. They wanted him to swing, but he knew something they didn't, or rather, something they chose to ignore. He knew that the pitcher would eventually get tired. He knew the game was running long, and that eventually desperation and exhaustion would lead that pitcher to lob a slow, perfect pitch right over the middle of the plate. And he wanted to have all of his strength, all of his capital, ready for that exact moment. He was building his weapon, not for the party, but for the war he knew was coming. This story reveals one of the most powerful and insidious cognitive biases that plagues every single investor, the action bias. On a cerebral level, our brains are wired for action. For millennia, survival depended on it. When faced with a threat, a predator in the bushes, the humans who survived were the ones who did something. They ran, they fought, they threw a rock. The ones who sat still to contemplate the optimal game-theoretic response were eaten. This instinct is now deeply embedded in our neural circuitry. We feel an overwhelming compulsion to act because action equates to control. When our portfolio is down, we feel a desperate need to sell something, to buy something else, to rearrange the deck chairs, because doing so creates the illusion that we are managing the situation, that we are in control. In reality, more often than not, we are simply making things worse. Holding cash is the psychological antithesis of the action bias. It is a deliberate, conscious decision to do nothing. And for the human brain, doing nothing in the face of uncertainty is excruciating. Compounding this is the fear of missing out, or FOMO. When you see your neighbors, your colleagues, your friends on social media getting rich on some new stock or cryptocurrency, your brain's social comparison circuits go into overdrive. FOMO isn't just a feeling, it's a powerful evolutionary driver. Being left behind by the tribe was, for our ancestors, a death sentence. When we see the tribe getting rich in a bull market and we are sitting on cash, that same ancient part of our brain screams, "Danger! You are being left behind. You will not survive." It takes immense cognitive effort to override this signal. Another deep psychological principle at play is hyperbolic discounting. This is our brain's tendency to prefer smaller, immediate rewards over larger, delayed rewards. We'd rather have $50 today than $100 in a year. In investing, this manifests as a desperate desire to capture the last 5 or 10% of a bull market's gains, even if it means exposing ourselves to a potential 50% crash. The immediate reward of seeing our portfolio tick up today feels far more real and gratifying than the larger, abstract reward of having cash ready for a crash that might happen next year or the year after. Buffett's genius is in his ability to invert this. He has trained his brain to derive pleasure not from the immediate gratification of market gains, but from the delayed gratification of having what he calls optionality. The pleasure for him isn't in swinging. It's in knowing he has the power to swing with maximum force when the perfect moment arrives. He has rewired his own reward system to value patience above action. So how do we, as ordinary investors, translate this Olympian level of discipline into a practical applied mental model? We can create what I call the Buffett batting average blueprint. It's a step-by-step process to build this discipline of patience into our own financial lives. Step 1 is to define your perfect pitch. You cannot wait for the perfect pitch if you don't know what it looks like. This means sitting down, away from the noise of the market, and writing out your investment criteria. What specific metrics define a great business for you? Is it a price-to-earnings ratio below 15? A debt-to-equity ratio below 0.5? A consistent return on equity above 20%? A business that you can understand inside and out, within your circle of competence? Write it down. Be specific. This document becomes your bat. Without it, you're just swinging wildly. Step 2 is to create a cash deployment checklist. This is your rulebook. It states that you will not deploy a significant portion of your opportunity cash unless a specific set of conditions are met. For example, condition 1 might be, the S&P 500 must be in a bear market, defined as 20% down from its all-time high. Condition 2 might be, a company from my pre-approved shopping list of great businesses must be trading at a 50% discount to its intrinsic value. This checklist acts as a circuit breaker. It prevents you from getting caught up in the emotion of the moment and forces you to adhere to your own rational, pre-committed strategy. Step 3 is to implement a FOMO filter. When you feel that irresistible urge to buy a hot stock that everyone is talking about, you must run it through a series of questions. Question 1. Is this company on my predefined perfect pitch list? If the answer is no, you stop. Question 2. Does the current market meet the conditions on my cash deployment checklist? If the answer is no, you stop. Question 3. Am I buying this because it meets my deep long-term criteria, or because I am afraid of missing out on short-term gains? This conscious interrogation of your motives can diffuse the emotional bomb of FOMO before it detonates your portfolio. Finally, step 4 is to automate the process of building your cash pile. Set up an automatic transfer from your checking account to a dedicated high-yield savings account every single payday. This takes the emotion out of saving. You are not losing money to cash. You are automatically loading your weapon week by week, month by month. By systemizing the process, you build your cash reserve without having to fight a psychological battle every time. This blueprint transforms the abstract virtue of patience into a concrete, executable strategy. To truly appreciate the power of this approach, we must examine its antithesis, the path of the 99%. This is the path of the investor who is governed by action bias and FOMO, and there is no more poignant example than the dot-com bubble of the late 1990s. Let's create a character, a hypothetical but painfully real investor we'll call Frank. In 1998, Frank is a smart, successful professional. He's been diligently investing in blue-chip stocks for years, but he watches with a mixture of envy and confusion as his 25-year-old nephew, who knows nothing about business, makes a fortune buying stocks of companies with no profits, no revenue, and in some cases, no finished product. Companies like Pets.com, Webvan, and TheGlobe.com. Frank resists for a while, clinging to his old-fashioned ideas about value. But by 1999, the pressure is too much. Every day the Nasdaq index soars. Every news report is about tech millionaires being minted overnight. Frank finally succumbs to the action bias. He sells his boring, profitable blue-chip stocks and goes all in. He leverages his portfolio with margin debt to maximize his exposure. For a few months, he is a genius. His portfolio doubles. He feels brilliant, vindicated, and utterly in control. He has successfully timed the market. But he has made a fatal error. He is 100% invested. He has zero cash, zero liquidity, zero firepower in reserve. Then, in March of 2000, the bubble bursts. The Nasdaq, which had peaked above 5,000, begins a brutal, soul-crushing decline that will not bottom out for 2.5 years. It will fall nearly 80%. Frank's portfolio is vaporized. His margin calls wipe out his entire account. He is left with nothing. The most tragic part of Frank's story is not the crash itself, but what happened next. In 2001, 2002, and 2003, some of the greatest technology companies in the world, companies that survived the crash like Amazon, Apple, and Priceline, were trading for pennies on the dollar. It was the bargain opportunity of a lifetime. It was the fat pitch Buffett had been waiting for his entire career. But Frank couldn't swing. He was out of the game. He had no cash. He was forced to watch from the sidelines as the greatest wealth creation opportunity of his generation passed him by, all because he could not tolerate the psychological discomfort of holding cash during the final, frantic stages of the party. He chose immediate gratification and paid for it with a lifetime of regret. The financial connection here is not abstract, it is brutally mathematical. Holding cash is not just a psychological defense, it is a powerful offensive financial weapon that fundamentally alters the long-term arithmetic of your portfolio growth. Let's quantify the slingshot effect. Consider two investors at the start of 2008, each with a $100,000 portfolio. Investor A, like Frank, believes cash is trash and is 100% invested in an S&P 500 index fund. Investor B, our Buffett apprentice, is more cautious and holds 20% in cash, so she has $80,000 in the index fund and $20,000 sitting in a savings account. The market crashes. By March 2009, the S&P 500 has fallen roughly 50%. Investor A's portfolio is now worth just $50,000. He has suffered a catastrophic loss. Investor B's portfolio is also down, but not as much. Her $80,000 in stock is now worth $40,000. But her $20,000 in cash is still worth $20,000. Her total portfolio value is $60,000. She has a smaller drawdown, which is a significant defensive benefit. But the real magic happens now. At the market bottom in March 2009, when fear is at its peak, Investor B follows her cash deployment checklist. She takes her $20,000 weapon and buys into the battered S&P 500 index at its lowest point. Now, let's watch the recovery. Let's assume the market doubles from its bottom over the next few years. Investor A's $50,000 portfolio, having ridden the crash all the way down, doubles to $100,000. He is finally back to where he started. He has spent years just to break even. Investor B's portfolio is a different story. Her original $40,000 worth of stock also doubles to $80,000, but the $20,000 she deployed at the bottom also doubles to $40,000. Her total portfolio is now worth $120,000. By holding cash, she not only lost less on the way down, but she ended the cycle 20% wealthier than the fully invested investor. This is the slingshot. The cash acts like a powerful elastic band, pulling the portfolio back not just to its starting point, but far beyond it. This is how holding a lazy asset actively contributes to beating the market and dramatically accelerates long-term capital gains. It is the mathematical embodiment of the principle. He who has cash when the crisis hits, wins. This is the first, foundational pillar, using cash as a tool of psychological discipline to wait for the perfect moment. The second pillar expands this idea from an offensive strategy to a defensive one. It is the concept of the fortress balance sheet, where cash is not just a weapon in waiting, but the very moat around your castle, protecting you from the inevitable sieges of an unpredictable world. It ensures survival, which is the non-negotiable prerequisite for success. To understand this, we need to look at the engine room of Berkshire Hathaway, its massive insurance operations. The story of Geico, Berkshire's crown jewel, is a masterclass in this principle. On the surface, an insurance company sells policies, but what it truly does is collect premiums from millions of people up front, and then it holds that money, called the float, before it has to pay out claims later. For most insurance companies, this float is a dangerous liability. For Buffett, it is the ultimate asset. He has famously said that Berkshire gets paid to hold other people's money. But this massive pool of capital is not just for investing, it is, first and foremost, a promise. A promise to every policyholder that no matter how catastrophic an event, Berkshire will be able to pay their claim. This principle was tested in the most extreme way on August 24, 1992, when Hurricane Andrew, a Category 5 monster, slammed into South Florida. It was, at the time, the costliest natural disaster in U.S. history. The storm obliterated entire communities and generated an unprecedented wave of insurance claims. Several smaller, less prepared insurance companies were completely wiped out. They had been run with a focus on short-term profits, keeping minimal cash reserves and investing their float aggressively. When the storm hit, they were insolvent. They could not honor their promises. They failed. Berkshire Hathaway, with its colossal cash position and fortress balance sheet, was different. They paid out hundreds of millions of dollars in claims without breaking a sweat. But here is the genius part. In the immediate aftermath of the storm, the entire insurance industry was in a state of panic. The companies that survived were terrified of another major event. They dramatically increased the prices of their policies. The supply of insurance cratered while the demand remained constant. This created a, quote, hard market. And who was in the best position to profit from this? The one company that everyone knew had the unshakable financial strength to weather any storm, Berkshire Hathaway. They were able to write massive new policies at incredibly profitable rates, precisely because their cash reserves had proven their indestructibility. Their cash was not just a defensive shield, it became an offensive tool to gain massive market share and profits from the ruins of their less prepared competitors. They didn't just survive the hurricane, they emerged from it stronger and more dominant than ever before. The underlying psychological principle at play here is one of the most powerful drivers of human behavior: loss aversion. As documented by the Nobel laureates Daniel Kahneman and Amos Tversky, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This is why financial panics are so much more violent and rapid than bull markets. The fear of loss is a far more potent motivator than the desire for gain. A fortress balance sheet, built on a thick foundation of cash, is a direct antidote to loss aversion. It ensures survival. In business and in life, you can recover from a missed opportunity. You cannot recover from being wiped out. The entrepreneur who has a massive cash reserve can endure a recession, a supply chain disruption, or a key client going bankrupt. The entrepreneur who is running on fumes, with no cash, is fragile. One bad month, one unexpected event, and their dream is over. The same applies to personal finance. An individual with a 6-month emergency fund in cash can face a job loss with a sense of calm and control. They have time to find the right next opportunity. An individual with no cash savings who gets laid off is thrown into a state of pure panic. They are forced to take the first job offered, to sell their assets at the worst possible time, to make desperate, fear-driven decisions. The cash is not just money, it is a buffer against the crippling psychological terror of ruin. It buys you the most valuable commodity in a crisis: time to think rationally. This is the concept of anti-fragility, popularized by Nassim Nicholas Taleb. Something that is robust, like a rock, resists shocks. Something that is fragile, like a glass, shatters. But something that is anti-fragile, like the human immune system, actually gets stronger from shocks and stressors. A business or an individual with a fortress of cash is anti-fragile. Like Berkshire after Hurricane Andrew, they don't just survive a crisis, they are positioned to profit from the chaos it creates. How can we apply this corporate-level strategy to our own lives? We use an applied mental model known as the 3-bucket system for personal and business asset allocation. This is a practical blueprint for building your own financial fortress. Bucket 1 is your emergency fund. This is the moat closest to your castle walls. It is non-negotiable. This bucket should contain 3 to 6 months of essential living expenses. This money is not for investing. It is not for opportunities. It is for survival only. It should be kept in the most liquid, accessible form possible, a high-yield savings account. It is your defense against job loss, medical emergencies, or unexpected home repairs. Knowing this bucket is full is the foundation of financial peace of mind. Bucket 2 is your opportunity fund. This is the Buffett cash weapon we discussed in the first pillar. This is the cash you are holding specifically to deploy when market opportunities appear. The size of this bucket is more personal. A younger investor might keep 10% of their investment portfolio in this bucket, while an older or more conservative investor might keep 25% or more. This money should also be kept safe and liquid, perhaps in a mix of high-yield savings and short-term U.S. Treasury bills, which are considered the safest asset on Earth. You need to have strict written rules for when you are allowed to use this money, as we discussed with the cash deployment checklist. This is your offensive arsenal. Bucket 3 is your long-term investment portfolio. This is where the rest of your capital goes, into stocks, real estate, or other growth assets. This is the engine of your wealth creation. The key is that the existence of buckets 1 and 2 protects bucket 3. Because your survival and your ability to seize opportunities are covered by cash, you will never be forced to sell your long-term investments at an inopportune time. You can let them compound for decades, weathering the inevitable storms, because your fortress is secure. This system provides a clear, rational framework for wealth management. It separates the concepts of survival, opportunity, and growth, ensuring that you are prepared for any contingency while still participating in the long-term growth of the economy. To fully grasp the wisdom of the fortress, we must look at the antithesis, the path of the 99%, the path of the over-leveraged and under-liquidated. Let's tell the story of a small business owner. Let's call her Sarah, an entrepreneur with a successful chain of coffee shops. In 2006 and 2007, business is booming. The economy feels unstoppable. Sarah decides to expand aggressively. She takes out a massive business loan, using her existing stores as collateral, to open 10 new locations in a single year. She reinvests every single dollar of profit back into the business, chasing growth. She keeps zero cash reserves, believing that cash sitting in the bank is a wasted opportunity. Her balance sheet is a house of cards, built with the bricks of debt and the mortar of optimism. In her CEO mindset, she is a visionary, a growth-oriented leader. In reality, she is fragile. Then, the 2008 financial crisis hits. Consumer spending evaporates. Her revenue plummets by 40% almost overnight. But her expenses, her rent, her payroll, and most importantly her massive loan payments, remain fixed. She has no cash buffer to see her through the downturn. She goes to the bank for a line of credit, but the credit markets are frozen. The bank says no. Within months, she is unable to service her debt. The bank that was so eager to lend her money a year earlier is now her adversary. They foreclose on her loans, seizing not just the new, struggling stores, but her original, profitable ones that she used as collateral. Her entire business empire, her life's work, crumbles into dust. She is wiped out. The tragic irony is that if Sarah had expanded more slowly, if she had kept just 20% of her profits in a cash reserve, a fortress fund, she could have survived. She could have weathered the storm, and as her over-leveraged competitors went bankrupt around her, she would have been in a position to buy their locations and equipment for pennies on the dollar. Her failure was not a failure of vision or work ethic. It was a failure to respect the principle of the fortress balance sheet. She optimized for the best-case scenario, and in doing so, guaranteed her own destruction in the worst-case scenario. The direct financial connection of this principle is tangible and can be seen on any balance sheet, whether corporate or personal. It's the concept of working capital, the difference between current assets and current liabilities. A company with strong, positive working capital, driven by a large cash position, has immense flexibility. It can pay its suppliers early to receive a discount. It can fund its own inventory expansion without needing to take on high-interest debt. It can meet its payroll during a tough quarter without panicking. Most importantly, it can survive a black swan event that disrupts its revenue. A strong cash position allows a business or an individual to operate from a position of power, not desperation. It avoids the immense costs associated with financial distress. Think about the costs Sarah incurred: late fees, penalty interest rates, legal fees for bankruptcy proceedings, and the ultimate cost of liquidating her assets at fire sale prices. These are the direct, quantifiable financial penalties for not having a cash moat. On the flip side, the financial advantage is profound. A company with a cash fortress can often acquire struggling competitors for less than the value of their physical assets. They capture what is known as a liquidity premium in reverse. Assets that are illiquid, hard to sell quickly, like a private business in a recession, trade at a discount. By being the one who can provide liquidity in the form of cold, hard cash, you get to capture that discount for yourself. This is a fundamental way that the rich get richer. They use their liquidity to buy the illiquid assets of the financially distressed. Building this fortress is a cornerstone of any intelligent investment strategy and a non-negotiable step on the path to true financial freedom. This brings us to our third and perhaps most powerful pillar, the optionality engine. This is where we elevate the concept of cash from a passive, defensive tool to an active, predatory weapon. This is the mindset that sees a pile of cash not as money, but as a stack of zero-strike call options on the best businesses in the world. And there is no greater story to illustrate this than Warren Buffett's performance during the darkest days of the 2008 financial crisis. By September 2008, the global financial system was on the brink of collapse. Lehman Brothers had just declared bankruptcy, the largest in U.S. history. The credit markets were frozen solid. Panic was absolute. No one was lending money to anyone, not even to other banks. The entire edifice of modern finance was trembling. And then, Warren Buffett's phone started ringing. On September 23rd, he received a call from the CEO of Goldman Sachs, one of the most prestigious investment banks in the world. Goldman was not in immediate danger of collapse, but the fear in the market was so intense that their clients were pulling money and their stock was plummeting. They needed a vote of confidence, an unimpeachable signal to the world that Goldman was sound. And the only signal that mattered was a capital injection from the most trusted investor on the planet. Buffett had the one thing that no one else in the world had in abundance: cash. And because he was the sole supplier of this desperately needed commodity, he could name his price. The deal he struck was legendary. He invested $5 billion into Goldman Sachs. But he didn't just buy common stock. He bought $5 billion of preferred stock that paid him a guaranteed 10% annual dividend. That's $500 million a year, every year, guaranteed by one of the top banks in the world. But that wasn't all. He also received warrants that gave him the right to buy another $5 billion worth of common stock at a fixed price of $115 per share, anytime over the next 5 years. It was a deal of a lifetime, an offer no one could have gotten just months earlier. Just weeks later, another giant of American industry came calling: General Electric. GE was in a similar position, unable to access the frozen commercial paper markets. Once again, Buffett was the lender of last resort. He invested $3 billion in GE preferred stock, also paying a 10% dividend, and also received warrants to buy common stock at a discounted price. In the heart of a financial inferno, when the world was selling indiscriminately, Buffett was not just buying, he was creating bespoke, high-return securities for himself. He was able to do this for one reason and one reason only. He had spent the previous 5 years accumulating a mountain of cash. That cash was his option. The 2008 crisis was the moment the option came in the money. He exercised it with breathtaking force, becoming the stable anchor in a world unmoored, and in the process secured billions of dollars in profits for Berkshire Hathaway's shareholders. The psychological principle that underpins this incredible power is a combination of scarcity and reciprocity. In normal times, capital is a commodity. In a crisis, capital becomes incredibly scarce. The person who possesses it holds all the cards. This scarcity creates an immense power dynamic shift. Suddenly, the most powerful CEOs in the world are not deal makers. They are supplicants. They are coming to you, the provider of capital, asking for help. This dynamic allowed Buffett to demand terms that were almost feudal in their one-sidedness. A guaranteed 10% dividend, plus equity upside, in the form of warrants? It was a deal that offered the safety of a bond with the explosive potential of a stock. He could demand this because he was the only game in town. The psychological need of Goldman Sachs and GE was not just for money. It was for the certainty and credibility that came with Buffett's investment. This triggered a sense of reciprocity. By saving them, he was seen as a partner, a patriot even, which allowed him to extract terms that might otherwise have been seen as predatory. He understood that in a panic, the emotional need for security is so overwhelming that sellers will agree to almost anything to get it. He wasn't buying stock, he was selling certainty. And he charged a very, very high price for it. The cash was the source of his leverage. Without it, he was just another spectator to the crisis. With it, he was the central banker to corporate America. This is the ultimate expression of the CEO mindset, not just participating in the market, but shaping the market to your advantage. How do we, as retail investors, possibly replicate this? We can't negotiate directly with Goldman Sachs, but we can adopt the same mental model. We can build what I call the asymmetric opportunity scanner. An asymmetric opportunity is one where the potential upside is many multiples of the potential downside. Buffett's Goldman deal was perfectly asymmetric. His downside was cushioned by the preferred stock dividend, while his upside with the warrants was virtually unlimited. Here is the blueprint for building your own scanner. Step 1. Identify the triggers for market panic. History shows these events happen every 5 to 10 years. They could be credit crises, pandemics, geopolitical conflicts, or technological disruptions. Study past crises to understand their anatomy. This prepares you mentally for the next one. Step 2. Create your shopping list. Just as you would before going to the grocery store, you need a list of the highest quality businesses in the world that you would love to own. These are companies with durable competitive advantages, strong balance sheets, and excellent management. Companies like Microsoft, Coca-Cola, or Johnson & Johnson. You create this list during times of market calm, when you can be rational and objective. Step 3. Define your strike price. For each company on your list, you do the work to calculate its approximate intrinsic value. Then, you determine the price at which it would become an irresistible bargain. This is your strike price. You might decide you'd be willing to buy Microsoft, for example, but only at a 40% discount to its current price. You write this strike price down next to each company on your list. Step 4. You wait. You build your cash pile and you wait. When one of your pre-identified trigger events occurs and the market panics, you don't look at the news, you look at your list. When a great company on your list hits your predetermined strike price, you execute your call option. You deploy your cash calmly and rationally, according to a plan you made when you were objective. This model removes the emotion and panic from crisis investing. You are not making a decision in the heat of the moment. You are simply executing a pre-planned trade. It transforms you from a victim of market crashes into a beneficiary of them. Now let's examine the antithesis of this model, the plight of the 99%, the forced seller. This is the individual who is on the opposite side of Buffett's trades. Let's imagine a character named David. In 2008, David has a good job, a mortgage, and a healthy 401k filled with stocks. He believes in long-term investing, but he has no cash reserves. He lives paycheck to paycheck, and his entire net worth is tied up in his house and the stock market. When the crisis hits, his company announces layoffs. David loses his job. Suddenly he has no income. His mortgage payment is due. His car payment is due. He needs money to buy groceries. He has no choice. He is forced to log into his 401k account at the worst possible moment, in late 2008 or early 2009, when the market is at its nadir. He sells his high-quality stocks at a 50% loss, not because he wants to, but because he has to. He is a forced seller. He is selling his shares of great American companies at rock-bottom prices to survive. And who is on the other side of that trade, buying those shares? It is the investor who has a fortress balance sheet and a pile of cash waiting. David's personal crisis becomes another investor's opportunity. He crystallizes his losses, locking them in forever, and because he sold everything, he misses the entire historic V-shaped recovery that began in March 2009. He is financially ruined, not because he was a bad investor, but because he was a fragile one. He had no optionality. He was a pawn of circumstance, forced to play a losing hand. The pain of the forced seller is the fuel for the returns of the patient cash-rich investor. They are two sides of the same coin. The direct financial connection here is stark and quantifiable. Let's analyze the raw numbers of Buffett's Goldman Sachs deal. Over the 5 years he held the preferred stock, Berkshire Hathaway collected $500 million in dividends per year for a total of $2.5 billion. Then, in 2011, Goldman Sachs bought back the preferred stock from him at a 10% premium, giving him another $500 million profit. So, on his $5 billion investment, he made $3 billion in relatively safe bond-like returns. But the real home run was the warrants. As Goldman's stock recovered, his right to buy shares at $115 became incredibly valuable. He eventually exercised these warrants, netting a profit of roughly another $2 billion. In total, a single transaction, made possible only by having cash in a crisis, generated a profit of over $5 billion for Berkshire. This single deal, executed in a matter of weeks, created more wealth than most large corporations generate in a decade. This is the explosive, non-linear power of optionality. A normal, fully invested portfolio might hope to generate 8 to 10% per year through steady compounding. By holding cash and deploying it opportunistically, Buffett was able to generate a 100% return on a multi-billion-dollar investment in just a few years. This is how you achieve truly massive portfolio growth. It doesn't come from grinding out small gains every year. It comes from long periods of patience punctuated by short bursts of aggressive, decisive action. This is the financial engine that turns cash from a dead asset into the most productive and powerful tool in your entire wealth-building arsenal, a key strategy for any entrepreneur or retail investor aiming for true financial independence. This leads us to the fourth pillar, which is perhaps the most subtle but also the most profound. It's the idea of cash as a clarity catalyst, a tool for achieving the emotional discipline required to execute these strategies. Because having the money is one thing, having the stomach to deploy it when the world is ending is another thing entirely. The ultimate story of this principle in action took place on October 19, 1987, a day known forever as Black Monday. On that single day, the Dow Jones Industrial Average fell by 22.6%, the largest one-day percentage drop in its history. To this day, no one is entirely sure why it happened so violently. It was a perfect storm of automated computer trading, portfolio insurance, and pure, unadulterated panic. The scenes from the trading floors of the New York Stock Exchange were of utter chaos. Traders were weeping, screaming, staring in catatonic shock at the flickering red screens. Fortunes built over a lifetime were being erased in a matter of hours. In Omaha, Nebraska, Warren Buffett was in his office. A reporter from the Wall Street Journal managed to get him on the phone to ask for his reaction to the unprecedented crash. His response was a masterclass in emotional detachment. He calmly stated that the crash doesn't mean a thing for the long-term prospects of the great businesses he owned. He said he saw it as an opportunity, that he had actually been buying stocks that day specifically of the Washington Post Company, a business he knew intimately. He was not panicked, he was not euphoric, he was rational. He was a clinician observing a patient having a seizure, knowing that the underlying constitution was strong and that the fit would eventually pass. How was this possible? A huge part of the answer is that Berkshire Hathaway had a strong cash position. He was not facing a margin call. He was not staring into the abyss of personal financial ruin. His survival was not in question. This cash cushion acted as a psychological buffer, insulating his rational brain from the primal fear that was gripping the rest of the market. He could think clearly because he was not in danger. The cash provided him with emotional clarity. It allowed him to see the chaos not as a threat, but as what it was, a temporary market dislocation that was presenting wonderful businesses at bargain prices. His ability to act rationally was a direct consequence of his prior decision to hold cash. The underlying psychological principles here are cognitive dissonance and confirmation bias. When you are 100% invested and the market crashes, your brain enters a state of extreme stress. You experience cognitive dissonance. You have two conflicting beliefs. I am a smart, rational investor, and I am currently losing my life savings. This dissonance is incredibly painful, and the brain will do almost anything to resolve it. One way to resolve it is to panic sell. The act of selling aligns your actions with your fear. The new belief becomes, I was right to be afraid, and I took action to protect myself, which resolves the dissonance, even though it is almost always the worst possible financial decision. Another path is confirmation bias. You might desperately search for any piece of news, any random opinion, that confirms your original belief that the stocks you own are good. You might irrationally double down on your losing positions, throwing good money after bad, because to admit you were wrong is too psychologically painful. A cash cushion acts as a powerful circuit breaker for this destructive mental loop. Having cash means you are not all in on a single outcome. Part of your portfolio is safe, which lowers the emotional stakes. It allows a part of your brain to remain detached, to be an observer rather than a participant in the panic. It gives you the mental space to say, my stock portfolio is down, but that's okay. My plan accounted for this. My cash reserve is ready, and my survival is not at risk. This inner monologue is impossible for the fully invested, terrified investor. Cash is not just financial capital, it is psychological capital. It is the fuel for rationality in an irrational world. So how can we build this mental fortress? We can use an applied mental model I call the investor's Stoic journal. Stoicism is an ancient philosophy that focuses on differentiating between what we can control and what we cannot. The market's daily movements are outside our control. Our own reactions are within our control. This journaling exercise is a practical way to cultivate that Stoic discipline. Step 1. Once a week, perhaps on a Sunday evening, you open your journal. You write down your current asset allocation. For example, 70% stocks, 10% real estate, 20% cash. Simply seeing the cash percentage written down reinforces the fact that you are prepared. Step 2. You write down your biggest market fear for the coming week. For example, I am afraid that rising interest rates will cause a tech stock crash. Then, you write down your biggest market greed. I am greedy for the gains in my AI stocks, and I'm tempted to buy more. This act of naming your emotions externalizes them. It takes them out of your subconscious and puts them on the page where you can examine them objectively. Step 3. And this is the most important part. You write down exactly what you would do with your cash if your biggest fear materialized. If the market drops 15% this week, I will deploy 1/4 of my opportunity fund to buy more of my number 1 shopping list stock, according to my pre-written plan. This practice does two things. It pre-commits you to a rational course of action. It creates a plan before the crisis hits. Secondly, it rehearses the event mentally. By repeatedly visualizing yourself acting calmly and rationally during a crash, you are training your brain to do just that when the real event occurs. It's like a fire drill for your portfolio. This simple 5-minute weekly exercise can fundamentally rewire your emotional response to market volatility, helping you to truly internalize the discipline of an intelligent investor. The antithesis to this stoic calm is the emotional roller coaster investor, the 99% who are puppets to the market's whims. This investor's mood on any given day is a direct reflection of the S&P 500's performance. On up days, they are euphoric, confident, a financial genius. They check their portfolio app a dozen times an hour, reveling in the green numbers. This is when they are most likely to buy, adding more chips to the pile at the top of the market. On down days, they are anxious, irritable, and filled with dread. The red numbers on the screen feel like a personal attack. This is when the sleepless nights begin. They start reading doom and gloom financial articles, looking for confirmation of their fears. As a crash deepens, the anxiety turns to pure terror. They have arguments with their spouse about the money. They imagine a future of destitution. Finally, unable to bear the psychological pain any longer, they capitulate. They sell everything near the bottom, just to make the pain stop. The moment they sell, they feel a wave of relief. The dissonance is resolved. But this relief is soon replaced by a profound and lasting regret as they watch the market inevitably recover without them. This cycle of euphoria buying and terror selling is the guaranteed path to underperformance. Their portfolio is not a reflection of economic fundamentals, but a chaotic printout of their own unregulated emotions. They are their own worst enemy, and their lack of a cash buffer is the very thing that ensures their emotions will always have complete control over their decisions. The direct financial connection of this emotional discipline is a concept known as the, quote, behavior gap. For decades, research firms like Dalbar have studied the returns of the average mutual fund investor compared to the returns of the funds themselves. The results are consistently shocking. The average investor dramatically underperforms the very funds they are invested in. Over a 20-year period, this gap can amount to several percentage points per year. Why? It's not because they pick bad funds. It's because they trade in and out of them at precisely the wrong times. They buy after a period of strong performance, buying high, and sell after a period of poor performance, selling low. This self-inflicted damage is the behavior gap, or behavioral penalty. If you could simply close this gap, you could add significant alpha, or outperformance, to your portfolio without taking on any additional risk. Holding cash is one of the most powerful tools to close this gap. By acting as a psychological buffer, it reduces the compulsion to panic sell. By providing a ready source of capital, it enables you to buy when prices are low. It helps you to invert the destructive emotional cycle. The financial benefit is not just theoretical. It can be measured in the percentage points of return you don't lose to emotional mistakes year after year. This is a cornerstone of financial education. Mastering your own behavior is more critical to achieving financial independence than picking the perfect stock. And cash is the ultimate tool for behavioral mastery. Finally, we arrive at the fifth pillar, where the power of cash transcends the public markets and enters the realm of direct negotiation. This is the principle of the ultimate negotiator, where cash becomes a symbol of speed, certainty, and unrivaled bargaining power. There is no better story to illustrate this than Warren Buffett's acquisition of the Nebraska Furniture Mart in 1983. The company was founded by a tiny, indomitable Russian immigrant named Rose Blumkin, known to everyone as Mrs. B. She had started the business in a basement in 1937 with a $500 loan and built it into the single largest home furnishing store in North America with over $100 million in annual sales. Her motto was "Sell cheap and tell the truth." Buffett had admired her business from afar for years. One day he went to see her. He was 53 years old. She was 89. He told her he wanted to buy her company. Mrs. B, who was famously tough and skeptical, looked him over. She had received countless offers from other companies over the years, complex deals involving stock swaps, financing contingencies, and teams of lawyers. She had rejected them all. She asked Buffett how he proposed to do the deal. He told her he would write her a check. He wouldn't even audit her books. He trusted her. He simply asked her how much she thought the business was worth. She gave him a number: $60 million. Buffett thought for a moment and said, "Okay." The entire negotiation took less than an hour. The contract was a simple one-page document. He paid her with a check. Why did Mrs. B, who had turned away so many other suitors, agree to sell to Buffett? Because he offered her the one thing no one else could: absolute certainty. His cash offer eliminated every single point of friction and uncertainty that plagues most business acquisitions. She didn't have to worry about his financing falling through. She didn't have to worry about the value of stock she might receive in payment. She didn't have to endure months of intrusive due diligence from accountants and lawyers. She got a fair price, in cash, immediately. Buffett's massive cash position was not just a financial asset. It was a representation of his credibility and trustworthiness. It allowed him to cut through all the complexity and make a deal based on a simple human connection. His cash was his bargaining power. It allowed him to acquire a phenomenal, cash-generating business at a fair price with virtually zero friction. a business that has since gone on to generate billions of dollars in profit for Berkshire Hathaway. The psychological principle at work here is the profound human aversion to uncertainty. The human brain craves closure and certainty. Uncertainty is stressful. It consumes mental energy. When you are selling a major asset, whether it's your private business or your family home, the process is fraught with uncertainty. Will the buyer's loan be approved by the bank? Will the home inspection reveal a major problem that scuttles the deal? Will the transaction get bogged down in legal wrangling for months? These are sources of immense psychological pain for a seller. An all-cash offer magically erases all of this pain. It is clean, simple, and final. It provides the powerful emotional reward of certainty. This is why, in many situations, a seller will accept a slightly lower all-cash offer over a higher but more complex and uncertain financed offer. The cash buyer is not just offering money, they are offering peace of mind. This gives the cash holder immense leverage. They are selling a highly desirable emotional state, certainty, and can therefore demand a discount on the asset they are buying. This power dynamic is present in countless transactions, from multi-billion-dollar corporate takeovers to buying a used car on Craigslist. The person with the cash is in the driver's seat. We can translate this into a powerful applied mental model for our own lives, the all-cash advantage strategy. This isn't just about investing. It's a blueprint for using liquidity to get better deals in all aspects of life. Step 1. For any large purchase, always probe for the cash discount. When negotiating to buy a car, a piece of furniture, or services from a contractor, make it known that you can pay in full, immediately, with cash. Ask the question, what is your best price for a quick all-cash close? You will be shocked at how often this unlocks a discount that wasn't previously available. Businesses have costs associated with financing and credit card transactions, and they hate the risk of a deal falling through. You are solving their problems, and you should be compensated for it. Step 2. Apply this principle to your career and business negotiations. A robust personal cash reserve, what is often called FU money, is the ultimate source of professional negotiating power. When you don't desperately need your next paycheck to survive, you can negotiate for a higher salary or a better position from a place of strength. You have the power to walk away from a bad offer or a toxic work environment. If you are an entrepreneur, a strong cash position allows you to negotiate better terms with your suppliers and resist pressure to take on unfavorable investment terms from venture capitalists. Your cash buys you independence and leverage. It ensures that you are never the forced seller of your own time and talent. The antithesis is the financing contingent person, the 99% who are perpetually at the mercy of lenders. This is the individual who is always in a position of weakness. They try to buy their dream home, but they get into a bidding war and lose out to an all-cash offer, even though their bid was slightly higher. The seller chose certainty. They try to acquire a small competitor to grow their business, but their application for a small business loan is slow and bureaucratic. The seller gets a faster cash offer from someone else and takes it. They are constantly losing the best opportunities, not because they lack vision or ambition, but because they lack liquidity. They are always paying a premium for their lack of cash, higher interest rates on their loans, higher prices for their assets, and the lost opportunity cost of the deals they can't even compete for. Their financial life is one of friction, uncertainty, and dependence on the whims of bankers. They are forever asking for permission, while the cash holder is the one who grants it. The direct financial connection is clear. By providing liquidity, you capture the illiquidity discount for yourself. This is a massive and often overlooked source of investment returns. In the world of private equity, for example, a significant portion of the outsized returns comes from this very principle. Private equity firms use their large pools of capital to buy entire companies, often with cash, capturing a discount that is not available to the average stock market investor. In real estate, a cash buyer can often negotiate a 5 to 10% discount compared to a buyer with a mortgage contingency. On a $500,000 house, that's a $25,000 to $50,000 instant return on investment, earned simply by having cash ready. This is a direct financial advantage that flows from the strategic decision to hold cash. It transforms your balance sheet from a passive statement of what you own into an active tool for creating value. It is the final, powerful link in the chain, showing how the patient accumulation of cash can be converted into immediate, tangible financial gains through the power of negotiation. This is the ultimate expression of building wealth, not just earning and investing, but structuring deals and transactions in a way that gives you a built-in advantage from the very start. It is the final promise of cash, fulfilled. You have made a significant investment of your time today, and in doing so, you have acquired a powerful mental tool. You have fundamentally rewired your perception of the most common financial asset. You no longer see cash as a lazy, useless drag on your portfolio. You now see it for what it truly is, a stored form of strategic power, a perpetual call option on future chaos, the ultimate tool for emotional discipline, and the source of unrivaled bargaining power. You have learned the first great secret of the world's most successful investor. But mastering the discipline of holding cash is only the first pillar in Warren Buffett's fortress of wealth. This profound patience is a powerful weapon. But a weapon is useless without knowing when and where to aim it. This discipline of patient waiting is rendered meaningless without its essential counterpart, the overwhelming courage to act decisively. How did he build the mental framework to not just save the cash, but to deploy billions of it into the very heart of a financial firestorm, when every headline, every expert, and every primal instinct was screaming Armageddon? That courage, that deep conviction, is not an emotion, it is a system. It is a set of rational mental models that allowed him to see clarity where others saw only chaos. It is the next piece of this map. The video that is now appearing on your screen is not just another lesson. It is the critical link that connects the weapon of cash to the target of opportunity. It explains the fat pitch principle and the circle of competence, the mental models that transform patient waiting into decisive, world-changing, wealth-creating action. Many will learn the lesson of holding cash. They will build their fortress and their arsenal. But few will learn when and how to fire the cannon. The choice to click is more than just a choice to watch another video. It is a choice to move from being a student of the game to a player on the field. Complete your mental arsenal. Continue your ascent